Hello and welcome to this week's Do More With Your Money podcast. Today we are going to be looking at the importance of setting your goals and achieving financial freedom, looking back at 2024 and looking at how we can kind of plan and track for 2025. I'm joined today by Tom and George, and we'll kind of get straight into it and have a little look about what the importance is and why it should be important to you. First things first, let's have a look at sort of setting a goal and why that's important, Tom. How is this helpful for clients to be able to achieve their kind of financial security, let's say?
Yeah, good question. The first thing I actually do with clients in a meeting is I say, what is the purpose of this money? Because, without a purpose, you can't really commit to the investment at all, really.
Yeah, absolutely.
And sometimes clients are a bit, I don't really know, I haven't thought about it. So I do give a few examples of what sort of some common goals are. So it might be, retiring on your own terms when you want to. Mm-hmm. It might be improve living standards. That might be one. It could be gifting with a warm hand, or spending more time with your family and doing hobbies. So there's all sorts of different individual goals that a client has, and no one client is the same. I think that's the key thing, really. So you do find that there's so many different goals out there for people with the money.
Yeah, absolutely. It'll also depend on kind of what stage of their life they are, won't it? I know for me, we speak to clients who are kind of at the very, very start of their investment journey. You then also have clients that are kind of in retirement and looking to accumulate on their investments and things. So it really does depend, doesn't it, where the clients are.
It certainly does. Just an example of that, what we mentioned before about the gifting side of things, that tends to be in later life that you get that sort of as a goal, and that's where clients have done a really good job of saving so well throughout their years, and they've actually done too good a job because they've probably got an inheritance tax liability if they're thinking about gifting. So that's again, that's one of the sort of goals that we look at, and that's more of a later life stage, whereas saving for a house is very early on in your investment journey, really.
And having a goal just helps you stay the course.
It does.
If you're investing in the markets, you're going to see volatility. Depending on how much risk you're willing to take, volatility will vary, but it helps you stay the course, because there is going to be events. Even this year we've had all sorts. We've had economic growth fears, we've had inflation fears, we've had elections, but actually come out the other end of 2024, and so far it looks like we've had a pretty good year for markets. So just keeping that focus can help you just understand why you invested in the first place.
Yeah, investing, it's not linear, is it? No. Unfortunately.
And
that's a big part of my job is just trying to understand behaviours, really, and looking at behavioural biases and stuff like that, and trying to control behaviour as much as possible, really. And we've had a good year this year, which has been good for investors, and those who are in 2022 have been rewarded for staying put. Which is good to see. So,
and our portfolios have been going since 2015, and look at the different events we've had. Brexit, Trump with the China trade wars, we've had pandemic, we've had the fastest interest rate hiking cycle in Europe, we've had war across Europe. It's been all sorts thrown at the market, and sort of staying the course. If you've been invested with the portfolios through that time, you've came out the other end, you've done very well.
Yeah, absolutely. I think kind of putting it back onto clients then, have they achieved their goals? Kind of what is a tracker? How do they know they've achieved it? I know that's something that they'll obviously speak with you about, their financial advisor as an example, but if you kind of scale it back a little bit, they'll not need to speak to you every single time they want to log in and check their goals and keep a track of it. What's kind of the best recommendation from you as to how clients can stay on track and really monitor it without having to speak to someone, say, every single time?
Yeah, the first thing is speak to a financial advisor, really, because one of the key elements of my job is actually creating cash flow forecasts for clients, and we can set them up at the start of the investment journey, and I typically do set them up right at the start with them, because what we want to first of all look at is if the current investments, where you've got them, we've got to take into account inflation, we've got to take into account growth rates, we've got to take into account taxes as well. Are you on track to achieve the goals that you have, which will probably be expenditure requirements essentially? And from there, if they're not on track, we can then put in plans in place to make sure that they do get to that desired outcome. So, for instance, if they're not on track, we could look at potentially increasing contributions into the investments and looking at pensions and ISAs to do that. So there's various different ways we can, put them on track if they're not on track. But once they're on that on that plan then going forward, it doesn't take that much, monitoring. Obviously, we have the annual reviews every year, and that's where we'll check over the cash flow models, and we'll look at the investments and make use of allowances and exemptions as well. So you've got all of that with a financial advisor, and it's just making use of that really more importantly, and using the client website as well, which is so good.
You mentioned annual suitability review there as well. So how important do you think it is that clients utilise this time that they've got within the year of kind of their investment journey? How important is it for them to utilise that review?
Yeah, it's so important because life changes.
Yeah.
And there's so many people's circumstances change, and we've got to make sure that to those changes that the portfolios are suitably aligned to their needs, essentially. And it's also a time for us to sort of reflect on legislation changes, make use of allowances and exemptions.
Yeah.
So it really is an important part of the financial advice, picture, really. And of course, it's a regulatory requirement as well, from our side of things, is to provide that annual review of them. So, we try and get as much out of that meeting as possible, really, with the clients.
Absolutely. What do you think are the most common pitfalls, let's say, in setting goals? So I know if you take kind of my team and what we do as an example, you get people that have kind of set a goal and they set it for like £10 million. Like that's never ever, well, potentially never ever going to be achievable for that particular client. What's the most common things that you have to deal with clients when maybe they're a little bit too vague? Or
I think actually that one that you mentioned there, that's a behavioural bias. It's over optimism, really, and optimism is actually a really good thing with investing. I think if you are optimistic, you will probably tend to do quite well with investing. But sometimes you can be over optimistic. Yeah. And what that means is you either don't save enough, for your retirement, or you take too much out of your investments early on in the sort of drawdown phase or the retirement phase, and it means that you don't really have as good a later life. Yeah. So that's one of them. But sometimes some clients can be, they actually don't set themselves a goal that's actually, they can be underachieving with the goal. And again, that sort of, it has a negative impact as well with clients. So, again, when you're looking at your goal, this is why it's important to speak to a financial advisor, because we can actually help you and tell you from the off if that goal is going to be achievable. And if it isn't achievable, how do we get there? Yeah. And that's why we do all that sort of cash flow for forecasts and stuff like that.
Yeah, definitely. So you then kind of move on to, so we're kind of tracking the progress, we'll log in, we'll look at the annual suitability reviews, and it's monitored on a ad hoc basis, whether the client wants to log into their account, if they want to speak to a financial advisor. You mentioned before, Tom, just about looking at like expenditure and assets and things like that. Is that something that you utilise or clients can utilise throughout the course of the year? So if they are maybe falling behind their track of goal, can they do anything to reach that again and bring it back up to speed?
Yeah, good question. I mean, when it comes to expenditure, I sort of split it into 3 different sections. Where I have sort of basic expenditure, I have leisure expenditure and luxury expenditure. Now we split it down even more broadly than that. But the reason why we sort of look at those different various expenditure types is because your basic expenditure is what you need just to live, essentially. And then obviously leisure on top of that's for stuff like hobbies, and luxuries is for stuff like holidays and stuff like that. So if the reason why we split it into 3 different sections like that when we're looking at it is if your expenditure is too high, then we can potentially say, well, you might have to cut your luxury expenditure at this date, and that'll put you on track to achieve what you want to do. So, we sort of break it down, and obviously, if it's not achievable, we'll tell them how to make it achievable. Yeah. The other thing about expenditure as well is actually taking into account inflation. I had actually had a client who I was speaking to the other day, and she was 60 years old, and when we went through the cash flow model with her, we factored into account inflation at around about 3%. Now, I think the long-term average has been about just under 3%, there or thereabouts. And actually, when you looked at the expenditure, it was about 40,000 at the minute at age 60. But once we got up to age 100, which is where we project the cash flow models to, it was just over £100,000. That was her expenditure. So it just shows you there you've got to factor into account inflation with all of your expenditure when you're going through it. So that could be, counteracted by, when you get into your later life, essentially you do tend to slow down on your expenditure. So you might not be spending as much on holidays and stuff like that. So we do tend to find that from around about 85 onwards, your expenditure does slow down a little bit in absolute terms.
Emergency expenses are an emergency fund. That's one thing that we do kind of get down into when looking at their annual reviews and stuff. How important is that for clients to have that emergency fund?
Yeah, again, it's really important. I mean, like, you know, cash does have a purpose. You know, we know that cash over the long term doesn't tend to, you know, do too well in terms of inflation, but you should have cash there for an emergency. So say if the boiler breaks down, or, you know, the roof's leaking, you've got readily available, you know, cash assets there to pay for those sort of events. So we typically say around about 3 to 9 months worth of expenditure as an emergency fund. If you're in retirement, it might be a little bit higher than that, depending on your circumstances.
Perfect. So people who are invested with true potential, George, you mentioned a little bit about kind of what's even happened in 2024. There's been quite a lot of crucial things that affected markets and caused kind of ups and downs, and kind of coming off the back of 2024, it looks like people have had quite a positive year. What do you think that it kind of has had the most effect, let's say, on the markets?
Yeah, great question. 2024, we've had this blend of actually quite a healthy economy. Take the US, a lot of that was supported by the consumers and government spending. You've had inflation, which has been cooling, so taking a lot of the pressures that we saw in previous years off, and this allows central banks to start to bring interest rates down. I mean, that's a fantastic environment for a multi-asset portfolio, because it's great for equities and it's great for bonds, which all of our clients are invested within our portfolios. Eases a lot of pressures on consumers, eases a lot of pressures on businesses, and therefore revenue, therefore profits as well. So it can be quite constructive, and the outlook which we set at the start of the year is broadly played out. You know, we came into this year, we thought this was going to be a good environment for equities. We thought it was going to be a very strong environment for the US market particularly, and we positioned that way. We also thought it was going to be good for bonds as well, because when you've got interest rate expectations coming down, bond yields are quite highly correlated. So we saw bond yields come down and the price go up. So you got a good return out of equities and bonds. So we were well positioned coming into this. One of the challenges this year has just been the narrow leadership which you've had in the US. And what I mean by that is, take the 500 biggest companies in the US. Well, there's 7 stocks within there which make up around a third of the market cap. So the total value of the top 500 companies, a third of that money sits with 7 companies. And a lot of these companies, we've termed them on this podcast throughout the course of this year as the Magnificent Seven. It's companies like NVIDIA who are behind the drive in artificial intelligence. And if we see the US market, which has done 22% this year, well, half of that return has just come from 7 stocks. So that's quite a narrow market. It's quite narrow compared to what we've seen through history. And that's been a bit of a challenge to try and sort of navigate that. What we have seen in other areas of the market, though, is, they've lagged the Magnificent Seven, but they've still delivered some fantastic returns. The returns that we've had out of, you know, most markets this year is been brilliant. And as we look into next year, we do actually expect to see some more broadening out in terms of sectors and regions as well. So the dominant forces which have been encouraging for markets this year have been robust economic growth, inflation cooling, central banks coming off the brakes in terms of interest rates, and that's allowed markets to push on. Narrow leadership in the States, but we do expect that to start abroad now. As we sit here today, moving, you know, into 2025, we're still pretty constructive on the outlook. If we look within our portfolios, still like equities, we're still, you know, allocating to regions like the US. Some of our managers speaking to this week are starting to see opportunities, starting to broaden out in other markets as well. Still like bonds, you know, the yields which you're getting on bonds, take government bonds, on average 4%. It's pretty attractive actually for quite a low risk asset in terms of default risk. It's a government instrument and they'll pay you 4% a year to hold it. So quite a lot of opportunity has been there through the year. I think with our managers, we've captured a lot of this. I think looking into next year, still optimistic, still a lot out there.
Absolutely. I'll go in with quite a broad question now then. So what do you think are the key takeaways from this year that are going to help clients in 2025?
Tom hit the nail on the head of having a goal, understanding what is it you want to achieve. Be very clear about the level of risk you're willing to take. and then we'll do the rest of the work for you. We'll build a portfolio which is in line with that risk appetite. If you're balanced, we've got a framework which says what that means in terms of the volatility you're willing to experience as an investor. If you're aggressive, we understand what that looks like, and if you're defensive, and everything in between. So be clear in terms of the level of risk which you're willing to take. That's really important. That's going to really drive the outcomes which you see. From there, we take your investments and we allocate it across a selection of international multi-asset managers, which essentially means they're not just buying one single instrument, they're buying tens of thousands of different instruments. We diversify that, and then we position your portfolio to say, this is what we want to, these are the markets we want to target to get the best outcome for you along the way. So that goal which you set at the beginning is really important in sort of determining how we're going to be positioning your portfolio and the returns which you can expect to see over the long term. With markets, there is no free lunch. You do need to expose yourself to some risk in order to generate a return. If we look at our portfolios, those which are the highest level of risk have delivered the highest level of return. It's never been a straight line, much like we talked about economic data and so on. There's always an event. That's why we're here. That's why this studio was built, so we can provide updates every morning on what's going on. But if you stay the course, if you partner with professionals, then that's the best recipe for success long term.
Perfect. Okay, so let's go on to 2025. We've kind of covered 2024 quite well there. We've spoken about, let's say, clients who've got goals, they've spoken to a financial advisor, they kind of know where their investment journey is leading to. Let's kind of strip it back a little bit and say, right, we've got a client here, they currently don't have a goal, they don't kind of know where they're going to, they don't know what journey they're going to be on, and it's a little bit vague for them. What are the kind of top tips that you would give them, let's say, to start that journey?
Yeah, I mean, think about what the purpose of the wealth is and the money that they've got is. And this might take a bit of deep thinking, because you might actually not know. And it might be something as simple as just being able to retire when I want to. Yeah. That's quite a simple goal. But it might be something a bit more, in depth. So it might be that I want to gift some money to my children at age 25 and to be able to do that. So you've got to have a real hard think about why you invest in this money. And like George said perfectly, if you don't have that purpose, how can you commit to investing long term, and how can you go through the economic cycles that we know we'll go through in the future? That is normal, and I think this is sometimes one of the biggest challenges with clients, is just telling them, look, economic cycles are normal, and it's about trying to guide them through those processes. And then they can be rewarded with good years like the one.
You've got to really put yourself there. You've got to really think about those different stages of life, and realistically, what is the life I want to believe in? What are the sort of things I want to have in place at that point in time? Because starting out on an investment journey, retirement seems a long way ahead. Yeah. For us, might not even get there, Tom, but you've got to really put yourself, at that age, what sort of setup do I want? And then how do I get there? You've got to work backwards.
Yeah. I think I think especially now for sort of like the younger generation, let's say, if you look at the kind of 18 to 25-year-olds, for me personally, looking back at my journey with investments and savings and things like that, it wasn't until I started in a financial company that I thought, actually, this is important. So it's kind of opening the message out to people and thinking, right, you actually need to start looking at this at such an early age. So where I kind of opted out of previous workplace pensions, it wasn't necessarily something I was enjoying the money and having a fantastic kind of youth, let's say. But it is something that people need to be thinking about from an early age, because really, by the time you're sort of 40, it's potentially a harder task to get to the goals that you need to get to.
I mean, I say this to all my friends. You've got to start. Starting in your 20s versus starting in your 30s can actually have a real significant difference.
100%,
even if you're on, quite a low salary at that time, which is what you expected to be on in your 20s, it can make such a big impact long term. Little and often is the key thing. Yeah. Especially when you're young, it's just trying to put little and often away. And then if you get a pay rise, maybe increase your pension contributions a little bit. Yeah. You've got to there's when you do go through pay rises when you're younger, you've got to have some reward for going through that pay rise. But if you can put a little bit aside as well on top of that, that's a really good way to start, and just keep doing that as you go on.
And then also you're going to be subject to potential market growth as well then, George, the longer you're invested in as well, aren't you?
Yeah, absolutely. If you're an earlier investor, you could probably afford to be taking more risk because you don't need that money until further down the line. And, you've got time to, if there is volatility, if there is drawdown in markets, you've got a lot of time to make that up. Yeah. So, you've got to, back to the thinking about your risk, how much risk are you willing to take, when do you need the money, that's going to determine the level of risk you're going to take. And
that's key for me.
Yeah.
Because you've got a long term, you can think about risk differently.
Yeah.
And you can experience the market cycles a bit more. And once you've got more experience of going through those market cycles, you react better as a result. So completely agree with that, George.
Perfect. So let's have a look at an actionable, let's say that right, an actionable roadmap for 2025 then for clients who maybe have a goal, maybe don't have a goal, and kind of what their year should look like. So reflecting on 2024, identify what's worked for them, what hasn't worked for them, and really kind of starting to get a plan into place. We're very near the end of the year. It will be here before we know it now. Kind of looking back at their financial habits. I know people that I know track their spending through things like their banking app and things like that, but actually that is something that they can do within the True Potential client site. So if that is something that they're interested in, definitely speak to a financial advisor or somebody within the team. Using a SMART framework of setting your 2025 goals, so specific, measurable, achievable, relevant, and time related as well. So kind of looking at all of those areas as kind of what's going to be the best for that particular client. Everyone's circumstances are different, so they are going to be, there's different. It's kind of not a one size fits all, let's say. Creating a monthly financial plan, speaking to your advisor, staying informed and adapting, tracking the progress throughout the year, and also, of course, if possible, stay on course. I think one of the key takeaways from this session for me is that clients do need to be aware of their goals. They need to think of them from an early stage and really kind of get that bigger picture as to what they want to achieve and by when. And as you said, Tom, it might be something as basic of I just want to retire at some point. So doing all of these things and using all of these tools that we've got here at True Potential can sort of massively help get to that goal. Especially
if you're a client of ours and you're watching as well, just even listen to the podcasts and stuff like that, and like listen to the topics that we discuss. Like that's so useful, and it's all about learning. The more that you clients can learn, the better investors it can be. Really,
staying the course is important. It's what has enabled us to deliver the long-term returns in which we have. On screen, we can see a comparator of the True Potential Balance portfolio relative to the industry. So the industry comparator here is ARC, which is the Asset Risk Consultants, and that's essentially it's 140 different providers in the UK and their returns, which they've delivered within that same risk profile. And it's all after charges and it's after platform charges as well. What you can see in the first column is since inception, we've delivered through to the end of the third quarter, 55.8% return. Now that's 11.5% ahead of our industry. So that's a long-term context there. And on the table below, you can see that puts us in the first quartile. So that puts us in the top 25% of returns within our marketplace as well. So that's the sort of return which has been delivered by staying the course over the long term throughout all of those different environments which we discussed, which is strong in absolute terms, but also the data is telling us that's very strong in relative terms as well.
And that gives clients confidence as well, isn't it? That that what you're doing in your team, George, is obviously a good job, and obviously we are monitoring and looking at our performance against peers. That's a really important thing for us as a company to be doing. Yeah,
absolutely. Thank you very much, both of you, for joining today and speaking about goals. I think it is such an important topic for clients, no matter at what stage of their investment journey they're on. If any clients are kind of now thinking about this, or maybe thinking their goal isn't actually suitable, I would absolutely recommend getting in touch with the team or your financial advisor, and we can discuss that with you. Also really utilising that annual suitability review that we do every single year for clients to ensure that they're on track and everything is still suitable for them. Thank you very much for listening today. If you do need any further information, please kind of give us a call, speak to your financial advisor, or look at kind of the blogs, podcast and posts and things that we do. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.